Welcome back to the channel. As always, if you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a stock called Sentinel-1, ticker S. What these guys do, they provide a cybersecurity service platform, which is not unlike other companies out there that you may have come across in the stock market. The most well-known out of all of them is CrowdStrike, which, as you can see, took a nosedive over the summer due to a glitch in the systems. So this left many customers in their client base exposed, and as you can see, the stock took a massive nosedive over the summer. Now, this represents an interesting opportunity for Sentinel-1, which, unlike other providers, has integrated AI into their offering in order to provide their customers with their competitive edge in terms of finding those cybersecurity threats. So that makes their platform, their offering, very easy to use, very intuitive. So there are other players as well. Tenable, we got, I think it's called CyberArk. There are a bunch of companies out there that are doing okay in this space. However, with Sentinel, I think there are a few interesting facts that are going to propel the stock forward quite a bit. So first of all, if we look at the chart here, in terms of the performance, you can see that the company has remained sideways since the end of 2023, having achieved an all-time high of 30. And that's the price target I'd be looking at. Why do we think we're going to get there? Well, first of all, the technicals are telling us that the stock is starting to reverse. But of course, that's driven by fundamentals. And the fundamentals are that in the last quarter, in Q2, they achieved their first ever positive non-GAAP net income and earnings per share. So in other words, they're starting to become profitable. Now, that quarter reported the first half of the year, and management was quite upbeat on their commentary, saying that they expect even better growth on the second half of the year. So their ARR growth will be improved compared to the first half. So we have been, for this period here, kind of sideways flattish. So if we make the assumption of growth being better than that, we should be able to get back to these levels. As a matter of fact, their confidence was quite strong because they increased their guidance for 2025 too. That confidence is driven primarily by early indications of go-to-market enhancements, a strong second half pipeline, improved competitive position, and also traction with new solutions that they're launching into the market. Also, something that I felt was quite interesting during the discussion was that in the earnings call, management said that they are seeing a departure from seasonality between Q2 and Q3 into a more sequential growth into the Q3 due to improved execution. So they made remarks about their sales force becoming better at what they do, improved execution, improving improving their business. So remember, this is a 7.6 market cap company, and because of that, something that will be very important here is how fast can they drive that revenue growth. So if we look at how that looks like, you see that their expectations were massively increased, and that's what's going to drive the needle for the stock considering the market cap. So in terms of their competitive positioning, they mentioned that their offering is less kernel-dependent approach than other providers out there. That could be a catalyst down the line, as Microsoft has tried in the past to get away from that structure. But overall, they see themselves well positioned to capture market share in this 100 billion plus industry, with 50% of the endpoint protection market still available for capture. And one of the reasons why they have been getting better recently in their performance was also the inclusion of what they call one of the products, Purple AI. So Purple AI surpassed their expectations and is part of the reason why Q2 outperformed versus their expectations, right? But this is still in the early stages. This is still in the early stages. So we could see this product really taking off and further propelling the company performance. So they said that the adoption of this product surpassed all their expectations. And what it does is that it brings AI, unifying, accelerating, and simplifying security operations. So some of the commentary was that Purple generative AI capabilities are a major competitive advantage, and they have time to market lead. It is already integrated into their platform and alleviates the challenges of machine speed responses. So they are launching new products about that. They are introducing summaries of alerts. And some of the commentary as well was that they were the first to do that, while other competitors are merely providing a demo and pricing. They already started rolling out this product with double-digit attach rate on all eligible endpoints in Q2. So they have begun to deliver this on some customers in Q1, and now they're getting faster. I think that traction can continue, right? Then a few things as well that I think are quite important. In terms of the remarks from management when asked by analysts, management said that at this stage they just want to give accurate projections, but they see a lot of growth. And that to me sounds cautious from management in terms of trying not to mislead the analysts or give them anything wrong. But I think the probabilities are that they are seeing a lot of demand and a lot of opportunity, but maybe it's just so vast that they quite not just point their finger as to how that's going to play out. So if we think in probabilities, it is likely that that growth is going to be substantial, maybe so substantial that it's hard to put a number on it. So to me, that sounds quite bullish in the short term for the company. A few other things to look into is that if we look at the ownership, we can see that smart money is well into the stock. So we have a bunch of hedge funds here that have gotten involved with this company. So there seems to be a lot of smart money on this trade. And whilst that is not a fundamental reason to be in, it signals that there is something going on here, right? And definitely it's going to fit the kind of situation that we want to be in, which is a company that has the probabilities in its favor to grow quickly, to potentially double in not such a long time. So When you look at the company, revenue growth is superior to all peers in financial year two. Yes, it still remains unprofitable, um, but it's growing very rapidly and is on its path to become profitable very, very soon. Mm, Also, uh, they have a significant spend on R&D. So if they were to cut that, that would massively increase their EPS. Is something that uh, is worth mentioning. And in terms of performance, like we said before, right, is one of the leaders. So we can have a look at some of the peers, such as Zscaler, doing a lot worse. Um, Palo Alto Networks also doing worse. So Sentinel's outperforming most of them, coming from less strong of a position compared to Cyber and CrowdStrike, which had been leading that market for quite some time. The volatility is also quite interesting. So if we look at the options, we can see that volatility, they're reporting on the 5th of December, the next earnings. Um, yeah, volatility is around 45%, which is pretty good. That's the kind of profile that we want to be in. And overall, they have a number of tailwinds on their side. So they have strong revenue growth, they have increasing market share, um, they have an expanding customer base. So one of the KPIs disclosed in their last earnings call was the number of customers with annual recurring revenue over 100,000. This grew 24% year on year, and it's been a constant number year on year. So if we look at that, it's grown from 797 in Q3 2023 to 1,233 as of last quarter. So that's like almost double in less than 2 years. That's not bad. That's not bad at all. Um, but also they're increasing their margins. They are putting in place strategic partnerships with Google, cyber insurers, and other type of entities. Um, in terms of headwinds that the analysts commented on during the earnings call, primarily was the competitive landscape, which is always going to be an issue with this type of cyber companies in the macro uncertainty. But that last one is applicable to any kind of company. Um, so overall, this seemed to be a stock that's going to have plenty of momentum still going on. In terms of risks, product innovation could quickly change. That's always going to be a risk with a sub company, and we will have to keep an eye on their market positioning. But that is something we just need to keep an eye on. The remaining purchase obligations, by the way, is still quite strong. So in the last quarter, they grew 40% year over year, which it is pretty significant. Their net retention rate, even though it's been decreasing quarter over quarter over the last couple of years, is still very positive. So currently sitting at 115%, down from 130 2 years ago. Yes, it is a decrease. However, it's still a very, very good number. And I think it's natural when you see a business scaling like that. So, for example, we go back to the financials. Uh, we can see that back then, this is Q3 2023, the company had 150 million revenue. Now it's sitting at almost double that. So Of course, as you get bigger, those numbers are going to get normalized. But at the same time, if you look at what they're doing, right, in terms of margin, the margin has actually increased since that from 64 to 74. So to me, that is just part of that scale trajectory that they're embarking into. EBITDA margins also improved, while still negative, is improved a lot from 97 to 34. And same goes for net income margin. So to me, all those things are part of the game. Now onto the structure. So, like we said, the company will be reporting earnings on the 5th of December. Not yet confirmed, but let's call early December for the sake of illustration. And the structure that I see working well here would be long the 24s at the December ones, long 24s at 220, 225, and short the November 24s on a 2-for-1 ratio. So assuming a $30 price target, that gives us 150% return. And if we were to reach that level after the November expiry, would provide us with 340% return. Hope you enjoyed the video. See you soon.